So are we starting to see real cracks in the rally, and what a rally it's been? Let's talk about that. What could be some of the causes? Caterina Simonetti joins me now. She's Senior Vice President at Morgan Stanley Private Wealth Management. And Doug Ramsey is the Chief Investment Officer at the Luthold Group. Welcome to you both. So, Caterina, let me start with you. I mean, for some context, we're coming off a two-year stretch in which the NASDAQ is up 80% and the S&P is up, I think, 35. I mean, so in context of, and we've been for months talking about how the fear and greed indexes are at all-time highs, and we know what's going on with the valuation. And look at how much Zoom is down from the peak. I mean, the software names have definitely been telling you that some kind of correction is coming. But what kind of correction do you think this is if it's more than just a one-day reset?
Kelly, thank you for having me on the show, and Happy New Year. And are we really surprised? Of course not. We had quite a lot of a big rally. A lot of large cap names, specifically in tech, got a little bit ahead of themselves. And we expected this. We expected that there would be some type of a correction, some type of a sell-off. And so now we're experiencing it. And the key here, the real question is not what is happening today and what sectors are down today, but what we can expect from this year. And quite frankly, despite of the short-term uncertainties, we are finding ourselves in the bull market. So this correction, this bit of a sell-off, whether it's short-term or longer-term, should be viewed as nothing but a buying opportunity, an opportunity to reposition the portfolios.
And I mean, Doug, here's the question. Where else do you go, right? I mean, we just heard people talking about how treasuries, I think it was Bryn last hour, Bryn Talkington, saying, why would you want to go into treasuries? It's hard to go into corporate debt right now. I mean, all of these valuations, when we were talking about the everything rally, that included bonds, right? There's just not a lot of value left, especially if we're talking about some inflation pressures today. So what are investors supposed to do? Just sit there in cash and hope that this is the big one?
I think some cash is okay. We're at our minimum allowable in bonds. I agree that, I mean, corporates, the risk reward looks really poor. Treasuries look really poor. If you see inflation getting anywhere close to that 2% Fed goal. So I think it's difficult. And the equities, and especially the large cap growth stocks, are priced off those incredibly low yields. So don't see a whole lot of value there. I think it's okay to have some cash, some gold, and to have an equity hedge.
Shepard Smith here. Thanks for watching CNBC on YouTube.